crash in crude prices and in many global goods prices due to Chinese exports, Reserve Bank's new liquidity rules requiring higher purchase of bonds, India's bond index inclusion are all very positive news for Indian bonds. So where are bond yields headed? Is 6% yield possible sometime in 2025? Likewise, given the dollar flows and the falling inflation rate differential between India and US, can the rupee appreciate over the next 12 months? These are the two seminal questions we are asking managers of two of the largest bank treasuries in India, B. Prasanna of ICICI Bank and Neeraj Gambhir of Axis Bank. Gentlemen, good morning and thank you very much for your time. These are very, very crucial questions. Prasanna, first, let me get the immediate out of the way. Yesterday's CPI number coming in a little higher than expected. We were building to some kind of a RBI softness expectation, bond yields going to 6.8. All that out of the way, is it a status quo or are you still expecting dovishness?
So, Latha, I think, yesterday's CPI inflation was a little disappointing. I mean, had it come to where we were all expecting, it would have been much better and the narrative would have been solidified. But at the same time, I also think that we never expected RBI to change stance very soon in October. And we were of the view that the earliest they would probably do is probably a change in stance in December, followed by a rate cut in February. So to that extent, I don't really think that it changes the narrative from our side, because if you really look at the overall, the fundamental factors that are driving our expectations from where it is, most of it seems to be in place with a very favorable global backdrop, oil coming down, expected inflation coming down, and goods inflation, like you spoke about with the Chinese growth where it is. So I think the narrative is building up. Maybe it is now slows down a little bit and some kind of a reality check that maybe not in October. But I must say that markets were anyway not factoring in a rate cut in October. I mean, it's more like a more dovish talk, which I still feel is kind of possible.
Oh, still kind of possible. Okay, that's important. Neeraj, what would be your spin in the near term? There was a lot of expectation, at least I heard in the market, that a softness of the Reserve Bank in October itself is possible, partly because of the debate stirred by the chief economic advisor questioning inflation targeting. And then, of course, good monsoon, crude crashing below $70. So are you expecting an earlier softness from the Reserve Bank than you thought before? Like probably December rate cut?
I think December rate cut looks a bit too aggressive call at this point in time. I think a change of stance in December is something which can be thought of, provided the inflation data in September, October and November is on the softer side than expected. The underlying inflation trend continues to be very soft. Core inflation is soft. I think what is spoiling the party is the vegetable prices. So if we see over the next 3 months that overall inflation, headline inflation numbers are somewhat softer than what RBI has forecasted, I think there is a possibility that we might see a change in the stance in the month of December. I'm not expecting a rate cut as yet. I think we still are in a situation where the headline inflation is quite above the target and is not expected to get to the target, at least in this financial year. Growth continues to hold up well, even though there is some softness that is creeping in. So all in all, I think still not at a stage where we can start calling out for rate cuts. But yeah, some change in the tone and tenor of the language can be expected in December.
Okay, let me move from RBI rate cuts to the market yield, which is a different story altogether. RBI has not done anything by way of rate cuts, but yields have fallen from almost 7.2 to 6.8. Of course, they've changed their liquidity. Prasanna, what's your sense in terms of yields? I'm asking you for the better part of 2025, calendar 2025. Your bond inclusion, LCR purchases, all that will start. And the estimate of LCR purchase also I would want from you. And therefore, what happens to bond yields?
So I think, Latha, beyond what we think the RBI is doing, like you rightly said, the market has gone ahead with a lot of other expectations. And if you really look at the number of factors that are responsible for this favorable outlook on bonds, first is the global backdrop. which is clearly getting more and more dovish as we head towards the Fed policy. In fact, today morning, there was an article in the WSJ which is kind of indicating that even now it is quite possible that the Fed might do 50 basis points. So those kind of, I mean, it's pretty clear that the Fed chair is favoring 50, but then he has to take the committee with him. And so it's a close call between 25 and 50. So that's one. Second thing is the fact that the Q2 inflation is also going to be 30 to 40 basis points lower than RBI's estimate. The third is the fact that our external situation, the CAD and the BOP, which is anyway already looking quite positive, now got a little bit more positive because of the fact that oil prices have been coming down. And like you rightly pointed out, liquidity, which is one of the reasons why it was kind of creating a roadblock for bonds to rally the early part of the year. RBI has consciously been letting more money into the system. The government is also consciously, I think, running down its WMA balances, which is one of the reasons why liquidity was tight, either by way of more spending or by way of reducing their borrowing. And then finally, the demand-supply balance, which is like you again said about the LCR, the FPI buying, and all the financial savings which is flowing into long-term funds. So I think all in all, it is a quite favorable environment for bond markets. And that is one of the reasons why we have seen the yields fall down. And as we go towards the calendar year end, I would see a slow grind lower. I wouldn't say something like 6% is possible, but obviously something like a 6.65 kind of a level is definitely possible as we go towards
25, 25%. 25%. In 25, do we see 6?
Oh, in calendar year 25. No, even then, Latha, I think you need to have a view of repo rate at 5.5 if you have to believe 6% on the 10-year is possible. So I still feel, we feel that our base case is for a 6% repo, in which case you can justify a 6-quarter 2-year yield and a 6.5 kind of a 10-year yield. But 575 has opened up, so it's in a probability right now. Okay. But I think we need, like Neeraj said, we need more data in the next 2 or 3 months for us to, solidify that view that a larger rate cut is possible in this.
Okay, a quicker answer from you, Neeraj. Where do you see the 10-year in 2025? I heard 6. That's why I'm asking you.
Yeah, I'll be much more briefer than Prasanna because he's covered everything. I'll say that for me, it's difficult to think about anything lesser than 6.5 at this point in time for 2025, because unless and until we have a clear view around rate cuts in the calendar 2025, I think it's difficult to imagine a 10-year bond yield lower than, repo rate plus some spread. At the moment, repo rate is 6.5. If you imagine that maybe 25 to 50 basis point rate cuts likely, then, maybe 6.5 is where the market would anchor 10-year at this point in time. And this is a slightly longer term view, subject to all the caveats about data and, a whole lot of other things falling in place.
Okay. So a 575 repo can mean a 6% bond, 10-year bond, because right now, look at the difference. It is 6.5 repo and 6.8 10-year. There's only 30 basis. So if the demand keeps...
If I may comment on that, I think the behavior of the yield curve in terms of its shape is very different at different stages of the cycle. Yeah. We are currently at the beginning of a potential rate cutting cycle, and therefore the yield curve is flat. But as you get through a few rate cuts, the curve may not stay as flat, and some steepness would be required to creep in.
It's maybe a little more, I completely take your point, but there's also the juncture that India is in terms of index inclusion, in terms of the narrowing differentials, which brings me to the rupee, Prasanna. Is there a gentle appreciation possible? We saw it once in 2008, if you remember. We came all the way from 45 to even 39 to the dollar by the time the fund flows were all in. And then, of course, the crash started. Do you think a year of appreciation is possible, 2025?
I think, Latha, the best person to answer this question is obviously going to be the governor and the Reserve Bank of India, because they are the biggest, that's one part. But if you have to look at just the market forces, I would tend to agree that with interest rates falling in the US, this time around, I definitely think that it's going to help emerging market currencies with FPI flows, equity and debt flowing more into emerging markets. And hence, India will also get the benefit of that. And in addition to that, like I was briefly pointing out about the macros, with most of the macros being where it is very positive, I think you can make a case for an appreciating, INR. But considering that we seem to, the fact that RBI is quite aggressive in building up reserves whenever there are inflows. And, of course, intervening on the other side when there is depreciating pressure as well. But since they have been very aggressive in building up reserves, I also feel that what is happening to the yuan and what's happening to the other competing currencies from a trade perspective is something that the RBI will have a close watch on. And just to close the argument, I would say that even if the rupee were to depreciate, I think it will depreciate far lesser than what is priced into the forward market, which itself you can consider is something like an appreciation bias. So it's not that the spot rupee will have to appreciate, but even if it doesn't depreciate as much as what the interest rate differential warrants, that itself is something like an appreciation for the rupee.
You answered the question I was going to ask you, that, is the depreciation going to be far lower compared to the year that was and compared to last historical averages? Neeraj, a similar question. Actually, KV Kamath yesterday made a strong argument that rupee is on the cusp of appreciation. He compared India to the similar position that China was and Japan was in their own periods of explosive growth. But for the RBI, is an appreciation on the cards, Neeraj?
Well, RBI is the most important driver and the factor. So I say, but
macros. I meant macros.
Yeah, but for the RBI is a very hypothetical question. Is it possible? Is it possible? Answer is yes. Yes. Is it probable? I would think no. I would still think that the need to accumulate reserves, the need to build a very strong external war chest, the need to make sure that rupee stays competitive. Mind you that even after all this, the inflation differential between India and the West would be close to 2%, right? So we still need to see a depreciating currency to ensure that our purchasing power and our external competitiveness is maintained. So I do feel that even if the flows turn significantly positive and the current account is very well behaved as it has been, I think the depreciation bias will continue. Obviously, I don't expect the currency to depreciate in a meaningfully large way. I think it'll be about 2 to 2.5% annualized rate of depreciation. That should be good enough for us to actually maintain that level of competitiveness that we need to have. I would also argue that the desire to have a appreciating currency might look good on paper, but actually it's a disinflationary as well as demand destructing sort of story, right? So I think we should anticipate some kind of mild depreciation.
No, I certainly don't want an appreciating rupee, and I'm on RBI's side. But I just want to ask you questions what the market wants. Just 2 words, please, because I'm disobeying my studio director in terms of time. Prasanna, the rupee range and the 10-year lowest yield that you see in FY25. In 2025.
You mean calendar 25?
Yes.
So I think I would put 6/4 to 6/2, not lower than that for sure.
Okay.
And the rupee range would be 83.75 to 85 kind of levels. 84.75.
Neeraj, same question.
I think 84, 85 on rupee, broadly that range. And 10-year, I see it going. I mean, it's very difficult for me to see it below 6.5 on a sustainable basis at current juncture.
All right. Thank you very much, gentlemen. I overshot time, but thank you very much for your answers. I have to take a break. Chartbusters come.